The once frozen real estate debt markets are beginning to thaw, according to a new report by Fitch Ratings. I'm joined by Stephen Marks, Fitch Managing Director and head of the agency's U.S. REIT group. How would you describe the access to debt in the REIT market today?
I would say that the unsecured debt markets are available to issuers, given the fact that approximately $4.6 billion of unsecured debt has been issued by REITs since the beginning of August of 2009. However, I would say that the secured markets remain challenging for many public and private real estate companies to access at this time.
What are the factors driving this revived access to debt?
I think it's the fact that a lot of public REITs during the first 8 months of this year issued follow-on common stock offerings, and that has helped to reduce leverage and also improve the liquidity of many public REITs. And so I think that has caused spreads to tighten in the unsecured bond market because the perception of credit risk is a lot less than it was about 6 months ago.
How does the availability of debt compare between public and private companies?
Sure. What we're finding is that the public REITs are able to access the unsecured bond markets relatively easily, and I think that's due to the fact that all these companies have registered these securities with the SEC, so therefore the ability to execute an unsecured bond transaction is a lot easier than for a private company that does not have registered securities. I would also say that on the secured side, public REITs are able to access the secure markets incrementally better than private companies, given these companies' track record, the fact that they're public, that there's public commentary about these companies. There's a perception, I think, that there's a slightly stronger sponsorship from a public REIT as opposed to a private entity. So on the margin, while the secure markets do remain challenging for most commercial real estate owners, the public REITs I think have an advantage.
Going forward into 2010, what do you expect regarding the access to debt in the REIT market?
Well, I think as long as spreads remain where they are or maybe tighten a little bit, that we'll see continued unsecured debt issuance. The one thing that we are concerned about, however, is that even beyond 2009, when we look at 2010, 2011, and 2012, there still is a significant amount of debt maturities during those years. So while companies have been able to improve their liquidity profiles in the near term, we still do have some concerns that over the longer term, companies do have a lot to do in terms of improving their liquidity profiles.
For REIT.com, I'm Matt Bishar.